Hey, good morning, good afternoon, possibly even good evening, depending on where you're tuning in from. And welcome to the Trading Analysis 2022 Navigating Volatile Trends webinar. We're glad to have you here today. Thank you for taking time out of your Saturday afternoons or mornings to join us. We're glad to have you on board. Good morning, Terry. How are you today, sir?
Hey, Bennett. Everything is just a little peachy down here in Southeast Texas. It got a little chilly overnight, but it's springtime. We're expecting it to warm back up. So we got
That's the
daylight
hope.
savings time tomorrow. Got to remember that.
That's
Lose an
right. We're
hour
going
of
to lose an
sleep.
hour of sleep tonight. Yep. It's I tell you what, when we had I think it was the most recent cold freeze, there was like a 58-degree swing in a 24-hour period or something obnoxious like that. So good times, good times. But hope you're staying warm. Hope you're staying warm. We got down to, I
Oh
think,
yeah, oh
26.
yeah. It's a good day to be inside watching your webinar.
That's right. That's right. We got one viewer tuning in who said he's in Florida currently and it's raining. At least it's sunny here. It's sunny out. We've got
Yeah,
blue skies, but
I
it's
think
cold.
there's a pretty wicked cold front blowing through the southeast right now. Some tremendous thunderstorms. So y'all be safe.
Yep, absolutely. So hey guys, thank you all for jumping in here. As we're getting started and people are joining, we typically have people still coming in 5 to 10 minutes after we get started. Just out of curiosity, we're always interested in where you are tuning in from, whereabouts in the world. If you could drop in the questions, where you're at, where you're tuning in from, and we'll get ready to get started here. We've got a good event planned for you. Goodness, markets have been extremely volatile since the late 2021 high, specifically going into November. We had the pullback into December. We rallied to start the new year, 2022, and we ended up seeing continuation lower, and markets are now up against likely a quarter point move from the Fed next week. We'll be seeing that following what was another hot CPI report for the month of February. It was actually January CPI data that really ignited the secondary decline that we saw in the indexes. But with all of the uncertainties and gosh, now the geopolitical uncertainties with the Russia and Ukraine situation, many of you are wondering if this is the start of a larger bear market trend. And if you've been following our work for any length of time, you'll know that going back to June of last year, we had forecasted a top for the Nasdaq 100 right at about 16,000. But as we get to the 16,000 high, I think the high was about 700 points above the 16K handle. We just don't yet see the signs to suggest that larger trend is here. So what are you seeing, Terry? Where are they tuning in from today?
Well, let's see. We've got a world-class viewership here. Obviously, we got people from Florida. We talked about that. We got someone from Denmark, San Francisco, Minneapolis, uh, California, Boston, England, North Carolina.
The
We've got a
Netherlands?
fellow Texan from Driftwood. Hello, Gene. Let's see here. We got Switzerland, Philippines. Shout out to the Open Journal family. Thank you guys for joining us. We know it's 1 a.m. your time, so you guys are really up late.
Hey, Javi, glad to have you
Toronto.
on board.
Yeah, we got them. Netherlands. Yeah, they're just about everywhere. I haven't seen the Aussies yet, but they usually show up. So they're
I
still
hear
they're
that, and
still rolling in.
I see a question. The question was in regards to the screen right now. Yes, it is just the banner image for the webinar event. We last time had run our webcams, and there was some issues on the mobile side for people who were tuning in with the mobile GoToWebinar. So we thought we would stick to the presentation and stick to the charts. But yeah, we're going to get started here in just a second. Munich, very good. I've been to Munich. I've been to Straubing, which is not too far from there. A nice little town. Tell you what, the first time I drove on the Autobahn, I was just shocked at how efficient the traffic control was and
Stay out of the
whatnot.
left lane.
I learned that one the hard way. Learned that
Yeah,
one the hard way. I was doing like 130 in the fast lane, and I look in my rearview mirror, and there's a guy coming up flashing his
yeah. Get the
brights
hell
at
out
me.
of the way.
Yeah, move aside. All right. So hey, let's go ahead and get started. Looks like we've got a good turnout here. I think everybody is good to go. Just checking the back end. All right, let's get going. All right, so before we jump into the presentation, of course, the typical disclaimer, we are not investment advisors. You should only trade with capital that you can afford to lose. Past performance is not indicative of future performance, and you should consult with a registered investment advisor before making any investment decisions. All righty, so today's webinar event is navigating volatile trends, and the markets have certainly been volatile going into the year. There's been a lot of mixed opinions amongst the analyst community as to where markets are really going throughout the remainder of Q1, which we're rapidly approaching the end of, and then into Q2. So what we're going to do really quickly is take you through just a company introduction. I'll take you through the team. I will take you through our offerings. I will take you through our content delivery method and just give you an example of what we have to offer, how we communicate with our clients, and then of course we're going to get into some live market examples. We'll introduce our approach to market analysis, and then at the end we do have a promotional offer. All right, just checking through the questions, making sure nobody's having any technical difficulties.
Yeah, I'll flag those for you, Bennett. I'll try to run the background while you manage the presentation. Take the load off of you.
All right, very good. I appreciate that, Terry. So if you haven't heard of the company, tradinganalysis.com, we have been providing actionable market analysis and trade signals for the better part of 10 years. In fact, we just celebrated our 10-year anniversary. We utilize a combination of Elliott Wave, which is what we are here to talk about today. And in addition to Elliott Wave, Fibonacci it's a big component of that. And more recently, how long has it been, Terry, since we introduced Optima and RRG? Do you recall when that was we first started that?
Well, Todd and I kind of stumbled across it, I believe, in sometime around the summer of 2019.
Yep, that sounds about
And
right.
I'm the research director, right? So it's kind of my job to be looking for new technical tools and applications and stuff like that for the business, in addition to, sourcing trade opportunities and other things. I got a background in chemical engineering. I'm retired from ExxonMobil, and so this is my retiree job now, working this. And I've always had a passion for stock market and analysis. Never really had the time until I got finally retired, and then I jumped in and got involved with Todd Gordon's approach here. I learned his all his techniques in Elliott Wave and Fibonacci, and so he brought me on board. I guess, when did I come on board? Yeah, April 2018. So I guess I've been here 4 years now doing this. And then, yeah, so Optima, we got interested in Optima because everybody was talking about sector rotation, and we said, well, we were looking, everybody's target is to try to beat some type of a benchmark. Most people use the S&P as their benchmark, and if they're beating that benchmark, then that's a measure of success of your portfolio management. And so we're interested in, well, which sectors should we be in, and should we be more overweight? We don't want to just be the S&P. We want to be doing more like that. So we initially started doing some research into that, and I stumbled across some work from Julius de Kempenaar and his work around relative rotation analysis. And I got very interested and very excited on that. Well, we're going to have a webinar later this year. We'll introduce the Optima platform that we actually use with our clients here and do that work. So today's webinar is not all about that, but it took me maybe, I don't know, 6 to 9 months to really get a feel for what I was doing in that application. And then, now it's become a routine part of our delivery every week to provide a detailed sector performance analysis, and let our subscribers be aware of which sectors are up and coming and which ones are starting to lag and fade. And it helps you rebalance your portfolio by being in the right stocks at the right time. So
Yep, absolutely. And it's become more and more a part of what we do here at Trading Analysis. We will, as Terry mentioned, have some webinars later on this year discussing not only RRG but Optima in general. You can check out our Wednesday live stream. We host a Wednesday live stream show on YouTube. We've had Julius de Kempner on a couple of times, I believe. Once for sure. I thought we've had him on twice.
Yeah, at least twice. I think we need to invite him back again. It's about time. He's been busy raising horses now, I think.
Really? No kidding.
He
I
lives
think
in the Netherlands.
with this
Somebody who's
market
doing that is
volatility.
Ron.
What's that?
Ron, you know Julius de Kempenaar. You might see him on stockcharts.com. He does, I think, on every Tuesdays, he does a little bit of a sector analysis using the stockcharts.com platform. So, all right,
Yep,
Benny,
he is.
take it away. Back to you.
He's. I remember the first time I learned he was in the Netherlands, and he's a good guy, really, really great individual. So, a little bit more about the team Trading Analysis. Our analysis team consists of Terry, Alex, and myself. As mentioned, Terry is the research director. He's also a senior analyst. Todd Gordon, you might recognize that name and face from CNBC. He's been a CNBC contributor, I believe, going on 13 years now. I think he's in his third contract. He's the founder of tradinganalysis.com. He's now CEO of New Age Wealth Advisors. If you're interested in any long-term capital management, you can check out newagewealth.com. And then, of course, you can't forget the support and design team. Without the support and design team, we wouldn't be here. We wouldn't have these beautiful presentations that we can use to communicate our market analysis. We've got Tristan, our developer. We have Nick. Nick is in customer service. And then, of course, Joel, our lead graphics designer. At Trading Analysis, we have two distinct software partners. We have MotiveWave, which you're going to see us use a lot of today in the webinar. MotiveWave is really a fantastic technical analysis package for not just Elliott Wave and Fibonacci, but also GAN and just an overall general technical analysis tool. It has various ways in which you can organize your work. You can have different templates of indicators if you want to cycle between indicators. It really comes in handy. And then, as Terry was talking about, more recently we have started to work with the company Optima, and the relative rotation graph tool that we use inside Optima is just one part of the package. In fact, the RRG technology was invented by Julius de Kempner, and as Terry mentioned, you can also find it on stockcharts.com. I believe he's licensing it to the Bloomberg terminal as well, so it is available in various ways.
I think many professional trading platforms are licensed to use the RRG analysis. So it's something that's fairly new to retail traders.
Yeah, it's a great way to visualize relative strength and momentum.
Well, I tell you, once you see it, you're like, oh my God, I wished I'd have known this 10 years ago. So.
Especially in this sort of market environment, but it is a great tool to pair up with Elliott Wave. And then our two subscription packages, we have the Premier Trader, which focuses on the indexes and the sectors. We do stock analysis and option and stock swing trades. That typically is $177 a month. We do have a trial offer for you at the end of the webinar if you're interested in checking it out. And then if you're interested in cryptocurrencies, we also have our cryptocurrency trader package, which Alex leads up. He does a fantastic job. Alex comes to us from an institutional background and does a really good job with that service. A little more on the Premier Trader service if you're interested. We have nightly strategy updates, so Sunday evening through Thursday evenings. Obviously, no updates Friday evenings. We have a weekly member webinar that runs anywhere from 2 to 3.5 hours, depending on how the markets are trading. All of our content is delivered to you in a mobile application with iOS and Android support. And then we also have a team and community chat. Cryptocurrency Trader offers similar coverage, weekly member webinars. He also does chart sessions within our chat and cryptocurrency swing trades and general cryptocurrency analysis. Just a brief breakdown of our content delivery method. You can see a screenshot of our member website. As mentioned, we have a very extensive member backend. We've got a good development team, helps us to organize our content. All of our trades are available on the trade desk. Here's an example where you can see our entry, the exit, and you can go back and look back at any month. Here's a good example of the Android and iOS mobile application. As mentioned, all alerts are sent out via the mobile application. We used to use SMS text delivery, but found many of the providers were delaying the sending of those messages, and they weren't arriving in a timely manner. Okay, just to give you an idea of what we trade, how long we typically hold. Here's a Roku earnings trade. This was a 2-day hold. We put it on February 16th of this year. Picked it up for $1.88. We got out at $4.89 a couple of days later. We also do longer term swing trades. We had a short position on in Moderna via a put spread. Picked this up, what is this, February 9th. First exit was March 4th. Final exit was March 8th. In at 193, out at 280 and 387. And then as mentioned, we have kind of 3 core components, if you would, to our analysis process, which includes Elliott wave, Fibonacci, and relative rotation. All right, so I'm going to just briefly cater to those in the room who may be new to the world of Elliott wave and may have no clue what Elliott wave is. Elliott wave is essentially a form of technical analysis that is used to identify extremes in investor psychology. Elliott wave, or EW for short, as we like to call it, essentially identifies moves between extreme optimism and extreme pessimism. If you think about herd mentality, and if you're panicking as an investor, what do you think the investor next to you is doing? Likely the exact same thing. Elliott wave recognizes patterns that exist and repeat in financial markets, indicating the collective market sentiment at any given time. And I find it to be so fascinating that I can go back to markets that were trading in the late 1800s that were expressing clear Elliott wave trends, clear Fibonacci retracement levels. And in addition to that, we can show examples of a correction, for instance, that happened back in the 70s that is of significance today and that is dictating the depth and duration of corrections that continue to happen. Elliott wave is forward-looking and predictive, unlike traditional technical indicators, which are reactive and by design lagging. And when you understand the complexities of these pattern developments, as well as the psychology that's associated with each pattern, you can make more informed investment decisions. And when we're in a market such as the one that we've been in since, gosh, Q3 of last year, Q4 of last year, when the inflation narrative started to take hold of investor sentiment, we find it to be more important now than ever. So who the heck invented Elliott wave, you might be asking? Well, it's none other than Ralph Nelson Elliott, aka R.N. Elliott. He began his career as an accountant. He specialized in railroad buildouts, actually, through Mexico and South America. In 1924, R.N. Elliott was commissioned by the U.S. State Department to be the chief accountant of Nicaragua. And in the late 1920s, so a bit after that, he ended up becoming sick and was confined to his home. And he started to study the 1930 book, The Dow Theory. I'm sure many of you have heard of the Dow Theory or are at least familiar with it. So what Elliott ended up discovering is that financial markets trend and reverse in recognizable patterns. And so we started to compile those observations in what is now known as the Elliott wave principle. And that's something we continue to utilize to this day. So at the age of 64, after getting through his illness and compiling these discoveries, he actually launched a new career, and he moved back to New York. He started to manage wealthy clients' capital. His prominence grew in New York, and he actually had offices at 25 Broad Street and 65 Wall Street. So a very successful individual, born 1871, passed away in 1948. So how do we use Elliott wave, and how do we view the Elliott wave principle? Well, we view it to be a disciplined approach to pattern recognition, and we use it to gain market context while also limiting our exposure to risk. Elliott wave provides you a set of clearly defined and unbreakable rules. So most importantly, it's a trading and investing methodology where your analysis is wrong, which offers favorable risk reward or positive reward risk trading in the process. So it squelches the noise and it really leaves no room for emotion or second guessing. Again, offering positive reward risk trading. Let me show you just a brief example. Here's a trade we took in AMD, entering at 86, looking for an upside move in a wave 3 position. You can see we had an initial, if I can get my mouse over here, we had an initial move up in 1, sideways consolidation in 2. So here's a nice trend establishing wave. Here's a correction. We identified a smaller degree trend wave, smaller degree correction, and we were looking for continuation to our upside fib projections. You can see that price action met our upside targets. And what this allowed for structure-wise in terms of risk in the stock itself is from our entry point at 86.46, we knew that in the event AMD were to sell off and move south of 82.21, that would essentially invalidate the Elliott wave count. It would invalidate the view that particular upside move was going to unfold, and it would suggest there's something else going on. And so what that does is that allows for assuming 4.9% of downside risk in the stock to return potentially 13.2% of upside at our initial take profit target. And that's the stock itself. This is obviously not an options trade behind it, but it's a good illustration of the positive reward risk trading that Elliott Wave equips you for. So you might not be convinced. You might think, well, I've heard of many forms of market analysis, and we realize that there are many skeptics of the Elliott Wave principle. Unfortunately, there have been those in the industry that have given it a bit of a bad rep in that they only track one count. They aren't aware of the alternate possibilities, and so therefore their clients are left scrambling for context, and they're left without a plan B in the event their plan A analysis does not work in their favor. So while we do realize not everybody's convinced, we're convinced, and if you combine the team's market analysis experience, we've got over 40 years of market analysis, 20 years combined of Elliott analysis and Elliott Wave experience, and our conviction in Elliott Wave is met with others good company. Take Andrew Baptiste, for example. You might have heard of this individual if you follow our YouTube live streams. You may have seen him there. He was the chief technical analyst for JP Morgan and Morgan Stanley. I say plus 20 years. It was actually 30 years, I believe, he was with JP Morgan and Morgan Stanley. More importantly, he's been a name in the industry for many years. And he is quoted as saying, in essence, the wave principle is a simple rule-based methodology that allows the practitioner to dissect the collective mindset of the market participants, which allows for defined and attractive positive risk-reward trading and investing, also known as a game plan. You may not have heard of Andrew Baptiste, but you've probably heard of Mr. Paul Tudor Jones, worth over $7 billion from his hedge fund, Tudor Investments, and he's donated over $1.25 billion to charity. He is quoted as saying in the Trading Classics book, Market Wizards, the reason Robert Prechter has been so successful is the Elliott Wave theory allows one to create incredibly favorable risk-reward opportunities. That is the same reason I attribute a lot of my own success to the Elliott Wave approach. So while there are those in the industry and many within the retail trading community that outright dismiss Elliott Wave, it's a bit of a boys' club on Wall Street in that there are many top-tier technical analysts who are using this to their favor and using it, more importantly, to guide their investments and movements within the markets. Okay, so before we get to the live market analysis and show you where we feel markets are going into the remainder of this year, let me just show you a couple of different examples of Elliott across various asset classes. And we'll first start it off here with the chart of Amazon. So here's a chart of Amazon. We had a wave 3 high, at which point we see evidence of a 5-wave trend establishing decline. That trend establishing decline was retraced. We enter another motive decline in wave 3. Once wave 3 finished, notice it had a nice 5-wave subdivision of its own. And at that point, we were projecting Amazon to retrace between 1812 to 1858, and the center fib resistance was about 1840. Once we expected this 3-wave move to come to completion into this Fibonacci resistance zone, we expected a continuation move lower in wave 5 down to about 1650. If I take you to the next slide, you'll see that Amazon completed the 3-wave rally in the wave green 4 position. The actual resistance came in at 1840. So we had a zone of resistance on the chart, which suggested it would find resistance between 1812 and 1858. And what it ultimately ended up doing was finding resistance at 1840. 1840 happened to represent a quality to this rally here. So oftentimes within the world of Elliott wave, you will find corrections of what we call to be the same degree or same time frame, if you would, often demonstrate equality to one another in either duration or magnitude. So here's an instance where the magnitude of this retracement or counter trend rally in Amazon dictated the magnitude of this wave 4. And you'll notice our downside 1850 target was met. Next up, this is one I love going back to December of 2000, I believe it was 18, not 19, my goodness. Bitcoin had established a 19,000, near $20,000 high, and I'm going to get the date right here. Yep, it was December of 2017 that Bitcoin had established its high, and we were tracking the final decline into December of 2018. And what we were looking for is one final push lower. We had identified a zone of consolidation, and we were looking for Bitcoin to move lower and find support at about 3,100. You'll notice the triangle met resistance and proceeded to move lower towards our 3,100 downside target. Now you might be thinking, well, this is navigating volatile markets and volatile trends. What about major market turning points? Well, that was a good example of one, taking you back to the Bitcoin high of 19,000 and change, going down to the $3,100 area low. This is a great example of market psychology and how Elliott wave was used in our favor to identify this as an entry opportunity. Because what had essentially occurred was we had a very prolonged period of consolidation that was taking place above 6,000. And this consolidation effort for Bitcoin was a zone that many within the analyst community expected to hold. At the time, the cost to mine one Bitcoin was about $5,000 a coin. So analysts, traders expected a break south of $5,000 would essentially derail the underlying network and call for the end of Bitcoin as we know it. Our macro analyst and our crypto analyst, Alex, was on top of this move, and not only did he expect $5,000 to break, he had identified the 3,100 area low as his downside target in advance, expecting that breakdown to occur. This is a fun chart that I had put out for some family members on a social media platform, and it reads like this: breaking the hearts of believers everywhere as we break under $5,000 today. Can't say I didn't see this coming, as the pattern development has been extremely clear. I say I've been calling for, but we as a team have been calling for a move under 5,000 by November 14th for months, and it's finally arrived. And then we go into some technicals. And at the bottom, the most important part of this, just when the market shakes everyone out as we break sub $5,000 and millions liquidate positions at a substantial loss, it will come roaring back in the primary degree wave 5 breakout, and that it did. Another good example of forecasting a market top in advance is this chart here in front of you. This is a chart that goes back to October of 2019. And what we had identified in October of 2019 was a sideways period of consolidation for the S&P 500. We expected this sideways consolidation to break higher up towards 3,300 to 3,400, at which point we expected a significant decline to take us at or near the December 2018 lows. You'll notice we had this forecasted right at about January of 2020. And if you'll recall, markets met resistance. And as you can see in the next chart, after completing the 5-wave rally up, which did take us about 75 points above our fib projections, we complete the 5-wave rally, the coronavirus comes about, sets the social mood up for an impulsive decline, and we break straight south in the C-wave position. Another good example, moving to an individual stock in this instance, is the move from Tesla that we had back in April. If you look at this on a daily chart, it was April of 21, and we're actually on a 195-minute half-day chart, but this was coming off of the all-time high that we saw Tesla establish early in 2021. We had a motive trend establishing decline. After completing a trend establishing decline, we noted a counter trend move. Counter trend moves go against the higher degree trend. So in this instance, we have the motive move to the downside, the counter trend move to the upside. We expected resistance to come in between 768 to 806, and we were expecting that to give us a move down to as low as $467 a share, or somewhere within the previous wave 3 high. As you can see in the next slide, we met resistance, and while we did move lower, we didn't quite get the downside target, but it's a great example of identifying the underlying sentiment, utilizing the pattern interpretation to forecast zones of support and resistance, and more importantly, market trends. Back to Bitcoin. I love this one. This is going back to April 23rd of last year. It was actually the day Coinbase IPO'd that Bitcoin established its initial top north of 60,000, shy of the 74,000, 76,000 area fib resistance. And this is another good example of just when the analyst community was expecting the markets to essentially rally straight to 100,000. We had come out and suggested that we were meeting resistance in a wave 3 top and that we had a significant consolidation move ahead. Moving into the next chart, you can see we met the resistance and we entered about a 55% correction. If you follow us on Twitter, you can go back April 23rd of last year. We had posted this chart. Alex, our chief crypto and macro analyst, sees continued volatility on the horizon for crypto. If that is something you're interested in, we would encourage you to check that out. And then a final example of crude oil. This is going back to August of last year. August of last year, we had identified, again, a counter trend move that was moving against a higher degree uptrend. We had established a support zone between 61.34 and 63.17. That is where we expected the reversal to occur up towards $100 a barrel. And you can see the 5-wave decline got underway. Now, if you were with us last year, or if you attended the EW Hub forecasting event in June of last year, I had put out a chart, and you can see this was June 1st when we had the webinar right here in this candle. I suggested in that webinar that the NASDAQ 100 was going to reach a top between 15,300 and 16,000. Those were two of our highest degree fib resistance targets. And as you can see here, price action into those ranges was rejected. And while I would have loved to have called this over or nearly a year in advance and would have loved to present to you today a bearish market view to support continuation of the decline, we just don't see the underlying shift in sentiment yet. We do not see this as the start of the larger 2022 correction that we've been projecting for quite some time. Okay, you might be thinking, well, gosh, this is just far too complicated for me to ever utilize or understand. Chances are, if you are interested in trading or investing, you are aware of and familiar with perhaps the classic patterns of technical analysis. Elliott Wave simply takes it a step further and identifies where those patterns fit within a longer term trend, which allows you to have forward-looking analysis as opposed to reactionary lagging analysis that traditional indicators provide you with. So really, in the world of Elliott Wave, prices only exist in one of two forms. We have motive trend establishing waves. Motive waves go with the trend, either supporting an uptrend or supporting a downtrend. And corrective waves go against the higher degree trend. So if you're in a bull market and the motive waves are moving to the upside, your corrective waves are moving against that and offering periods of consolidation. If you're in an all-out bear market, then your motive waves are to the downside and your corrective waves are to the upside. And you can see the 3 Elliott wave corrections. You have flats, you have zigzags, you have triangles, and that's it. You also have combinations of those corrective patterns, but when you are able to understand these patterns and know where they fit within a higher degree trend, you can squelch the noise of the mixed analyst community and know when and where markets are telling you there's a change. So you have directional waves and you have correctional waves. So again, why on earth does this matter and why should you care? Well, we feel that it matters now more than it ever has before. And I'm going to illustrate this view utilizing a few recent headlines going back to even October of last year. So the first one says a 48-year market veteran warns that the Fed will be forced to tighten policy way sooner than investors anticipate as inflation continues to soar, triggering a stock market crash of up to 80%. Good times. The next one, this veteran analyst hears echoes of the 1929 crash in today's stock market. A lot of fear-mongering headlines out there. The next one, that same analyst putting out charts were 30% higher than the 2000 peak in stock market capitalization to GDP ratio. What about this one? This is March 23 of 2021, and it says, are stocks in a bubble? Investors seeing signs of YOLO trading, worried that the market is overinflated and that the bubble is about to pop. Here's another one. We've got 4 on this screenshot. Biggest crash in world history. A lot of bearish headlines. This one was 3 weeks ago. Elite Wall Street investors, stock market crash. They continue. And finally, I'll leave you with this one. A 47-year market vet explains why he sees the economy super cycle hurtling towards depression and lays out his case for an 80% stock plunge later this year. There's that 80% figure again. But did you notice anything strange about that last article? It was posted April of 2020. They were expecting the top in April of 2020. So I say this not to make fun of those analysts or to shame them. I put this in front of you so that you can see there's been many very intelligent investors who have missed out on massive returns due to the market uncertainties. And that is why we feel and we see the hard right edge as the best leading indicator. Sentiment manifests itself in pattern developments. And those patterns repeat, and when you're able to identify them, you can set yourself up for success, especially in a volatile market like the one we're in right now. So let's get to it. We're going to go hard right edge and take a look at some live market analysis. Give me just 1 second to get my screen share switched around, and we'll go to the charts. All right, Terry, do you have my motive wave up?
Yes, sorry, Bennett, I had it muted there. Yeah, I got your S&P red count.
Okay, perfect. So this is what we're going to do together. I'm going to take you over here and I'm going to create an untitled analysis file, and I'm going to show you exactly where markets have come from the 2009 credit crisis lows. First, we need to go back to March of 2000. And it's in March of 2000 that markets enter essentially a sideways consolidation with the first decline into 2002, a retracement into 2007, and then we have a trend wave to complete wave C. This structure, this 3-wave consolidation, finished in March of 2009, and it was coming out of March of 2009 that we see the evidence of our first motive. Remember, motive waves go with the trend of the higher degree, corrective waves go against the trend. So here we have a trend establishing motive 5-wave move. I'll go ahead and label this together with you. Up in 1, down in 2, up in 3, down in 4, up in 5. This gives us our first evidence of a 5-wave rally post 3-wave consolidation. From there, we see this wave one. So this 5-wave move completes a wave one of a higher degree because Elliott wave is fractal. We could take you down to a 1-day chart and count a 5-wave move inside of the blue third wave. So after 5 waves up, completing into just over 2010, we then enter another sideways consolidation. This sideways consolidation is met with a continued breakout, and you can ignore this over here for just a second. Notice this pattern here, this sideways corrective move, is very similar to the sideways corrective move that we have between April of 2010 and October of 2011. It's within this move that markets confirm the 5-wave rally off of the credit crisis lows, consolidate, and then we see the continuation development. This 3-wave trend yielded another 5-wave breakout. When looking at our wave 3 targets, remember, we use Elliott wave in combination with Fibonacci. Our first wave 3 objective includes equality of the magnitude of wave 1. So if you were to measure the magnitude of wave 1, project it from the completion of wave 2, look for an equal measured move breakout, that would give us 1966.14. That was our first upside S&P objective. That S&P objective was met in 2014, at which point it acted briefly as resistance. We get above it, we consolidate, and then we see the continuation development. Notice we have these in color coordinated, and with 3v1 equality as the blue reading, and then this green 1618 at 2855 is the most common wave 3 and wave 1 Fibonacci relationship. This is our trading analysis version of motive wave, and we have put this in the software to help when working and tracking waves. So the most common relationship, the most common Fibonacci relationship that you see demonstrated in a wave 3 compared to wave 1 is a 161.8% 3v1 projection. That came in at 2855, which, zooming in on price action here, we're now looking at January of 18. You can see that 1618 gave us resistance here. We consolidate, we move back briefly above it. Our September 2018 high of 2940.91. I'll never forget that high. I was trading it that day. A lot of these numbers just stick with you. From there, we have a 3-wave decline. So we've met the most common 3v1 fib relationship, and at that point, we see a 3-wave decline. Motive waves, as we looked at, that establish trends are 5-wave moves. Motive waves move in the direction of the higher degree trend. So this is a motive wave moving in the direction of our higher degree green 5-wave move. Looking at the corrective waves are typically 3-wave pullbacks. So what occurred from 2018 into 2018 is a 3-wave decline. One may have been inclined to say all of that is our wave 4 position, but as Elliotticians, we know that corrections of the same degree often tend towards equality in either the duration, the time elapsed in that correction, or the magnitude of the correction. So as an experienced Elliottician, we could look into that December of 2018 low and say, this is simply too short to truly be of the same degree and all of a wave 4 that would pair up to this move. Okay, number one, it would fall outside of the guideline of equality, and it would also fall outside of the guideline of the right look. If you're wondering what the guideline of the right look is, think of it this way. You wouldn't have a 5-wave move that looks like this. This would not be a clean 5-wave development, where this would be more in line with the guideline of the right look, where corrections are more proportional to one another, and you have clear isolated pullbacks. So we knew coming out of December of 2018 that with this 3-wave trend, we probably were still in a correction as we started to rally off of that December 2018 low. And that's why in our presentation earlier, we had showed you down here on the daily, I'm just going to kind of jump around for a brief moment, we had showed you the example we're coming out of our October 2019 B wave consolidation. That's when we were looking for the move up to 3,300 to 3,400 and then expecting that decline. So from October of 2019, we had anticipated a top and we had anticipated at least a continuation of the wave 4. So where are we now? That's the bigger question. Well, we have to first acknowledge two things. Number one, we have to acknowledge that in our view, a 5-wave move inside of this green third wave did in fact take us into the 2018 high. Remember the 1618 green 3-in-1 relationship? Check it out here inside of our green third wave. Within a 5-wave structure, in this case, we're looking at green 1, 2, 3, 4, 5. Whatever time frame you're tracking that wave on, you're going to have at least one of the waves, either the 1, 3, or 5 position, that has a clearly discernible 5-wave structure of its own. In this instance, it's wave 3. And within this wave 3 of the green cycle degree, you can count a nice 5-wave trend. This 5-wave trend also met resistance in wave 3 just above that very common 1618 3v1 relationship. It then corrects and gives us a pullback that is near equality to its wave 2. So the first thing we have to acknowledge is, number one, we view wave 3 as complete into 2018. And number two, we view the COVID low, the March 2020 low, as the end of wave 4. Going back to the guideline of equality, if we were to look at the magnitude of the wave 2 pullback that occurred here into 2011, circled here in yellow, and let me get rid of this just to clean up the charts for you. If we were to look at the magnitude or the depth of this wave 4 compared to this wave 2, we will see that we exceeded the magnitude of wave 2. So this is a more significant, deeper correction. But that guideline of equality is in duration or magnitude, or both. So let's take a look at the time elapsed between September of 18 and March of 2020, the COVID low. And let's compare this time elapsed to the wave 2 of the same degree. Because as I said before, I can take you to the chart of Honda Motor Company and show you a correction that happened in 1970 that is dictating the magnitude of corrections that are happening post 2000. Looking at the time relationship now between 4 and 2, we can very quickly reference that with a keystroke in motive wave, one of the various features that we absolutely love. And zooming in, look at this time relationship. Wave 4 versus 2 in time were equal to one another on February 24th of 2020. The low was March 21st. So 1 month off. That means a correction that occurred from April of 2010, concluding October of 2011, was 1 month off from being exactly the amount of time that we spent in the 2018 through 2020 market correction. So those are the two things that we have to acknowledge when we prepare to forecast the post-COVID low move. Number one, wave 3 completed. Number 4, we view wave 4 complete. What does that tell us? That tells us we're in a wave 5 position of a motive trend establishing development that originated into the credit crisis lows. Now, what about wave 5s? Because in addition to Fibonacci relationships that we see between 3 and 1 and 4 and 2, we also know a thing or two about a wave 5 position based on Elliott wave and Fibonacci. The most common wave 5 relationship when you have an extended third wave is equality to wave 1. Said otherwise, the magnitude of this post-COVID low rally projected from the wave 4 low is your first upside objective in wave 5. So we don't have to draw it manually with the Fib projection or extension tool. we can use motive wave, right click on our fifth wave and say ratio analysis 5v1. 5v1 came in at 4009.70. That level was met, it briefly acted as resistance, and we exceeded it. But when we met that 5v1 equality, we didn't have a completed 5-wave structure. Because as we looked at in wave 1, 5 waves completes a higher degree wave 1. 5 waves completes a higher degree wave 3. When we arrived at our 5v1 equality, we didn't have the subdivision here to substantiate anchoring that wave 5 and looking for a market decline. What's the next most common, or what's one of the most common wave 5 fib targets then when we exceed 5v1 equality? Well, that level comes in at 5 verse 1 and 3. Said otherwise, if you were to measure the magnitude of the rally from the origin of wave 1 or the low of the credit crisis, we measure the magnitude of it. In TradingView, you would click here once, click here twice, and then click the third time at the low of wave 4. So we're measuring the magnitude of this, and we're projecting it from the low of 4. That gives us a 618 at 54.8415. You can see here, 54.8415. So instead of drawing it manually, we can use motive wave to calculate it for us. So now what we have to do is we got to get ourselves off of the weekly time frame and focus in on all of the price action from the March COVID low. We're going to go off the weekly down to the daily. You can see the yellow circle for context. And what we need to look at in this post-March 2020 development is evidence of a 5-wave completion. Do we have evidence of a 5-wave move? Looking at the original development off of our COVID low, we see a lot of hesitation, a lot of overlapping within the corrections. And so initially, the wave count was a bit subjective coming off of the low. We knew that the wave 4 price low was 21. Let me fix that again. The price low for wave 4 was 21.9186. Our downside support and wave 4 target was 21.2254. So we knew we were likely coming out of wave 4, but due to the overlap, the count was a bit subjective. And it was in September of 2020 that we met resistance and see the largest percent correction set in. So this is the largest percent correction post-COVID low. What's interesting about that September area is this. Back to the weekly just briefly. Although there are multiple ways to draw trend channels, there are 2 distinct Elliott wave channeling techniques. Those channeling techniques, in this instance, we would be looking for a wave 5 high or wave 5 resistance. We accomplish this channeling technique by drawing a trend line from the low of 2 through the low of 4. We then project our parallel trend line over the completion of wave 3, not the high of wave 3, but the completion. Fortunately, this trend channeling logic is built in to motive wave, so I can just ask it to show the channel. And notice it's using the 243 trend channel, whereas if I move wave 4 from a price anchor, it will switch back to the other one, the other more common Elliott channeling technique. So coming out of the COVID low, we had an established trend channel. And if you'll notice, our September of 2020 market high is exactly just above the upper boundaries of that trend channel. So from the weekly down back to the daily, you can see we met resistance, but then we proceed into consolidate in a sideways 3-wave move. What does this sideways 3-wave move look like? A flat correction, a sideways consolidation. Here's another sideways flat consolidation. Here's a larger sideways flat consolidation. This is a smaller degree or shorter duration, if you would, version of that same pattern. So off the weekly, back to the daily. What ended up occurring is our first wave 1 completed here, and this is wave 2. And you might be thinking, well, how do you arrive at that conclusion? Well, we know Elliott wave is fractal in nature. You have smaller waves making up more significant higher degree waves that are longer and larger. So therefore, you would not anticipate and expect to see a situation where you have your higher degree, say weekly chart doing a 1-2 like this, and then you get a big, huge 1-2 in the smaller degree of trend. It's the higher degree wave corrections that are, in fact, your highest degree of trend. So down here, back to the 1-day chart, taking you back to the March COVID low, and I'll clean up all of our ratios. This was in the S&P about a 10% correction. That was the largest market pullback. So this is our first wave 1 and wave 2. From October of 2020, we rally into January 4th of 2022, and now we've been in a period of volatility, and many are left wondering if the bear is here and we're on our way back to 2200, if not further south. For the time being, the most logical and highest conviction interpretation of price action in the S&P 500 suggests this. At a very minimum, we see an initial move up, a correction, and then a secondary rally. So really, we have 1, 2, 3 waves. We have a 3-wave development so far. With our preferred view, we are suggesting that we are in a wave 4, meaning up in 1, down in 2, and we'll go ahead and decompose that ABC flat. Up in 1, down in 2, up in 3, we're now in 4. The markets will see one final push higher. We have a wave 5 fib cluster zone between 5,100, I believe it is, and I'm not sure where that fib went, between 5,100 and 5,400, and that is where we expect the more significant decline to potentially set in. So getting back to the daily chart, following the wave 2 completion, remember, we need to see a clear 5-wave subdivision in either the 1, 3, and 5 position. In this instance, due to the mixed sentiment coming off of the COVID low, there was a lot of uncertainties, a lot of indecision, and as a result, it was difficult to arrive at a high conviction wave count. Whereas now that you have the higher degree or more significant retracement, you can say with a high degree of certainty that this is a completed 5-wave rally, but it's still difficult to decompose it well. Whereas in wave 3 of our orange primary degree, we have a nice, clean 5-wave trend. The 5-wave trend, as we looked at earlier, in terms of the guidelines that are offered, we have the guideline of equality met, meaning the February 17th, 21 through March 5th of 21 decline dictated the depth of this decline and this market pullback. Equality, meaning this wave 4 would be equal to this wave 2, came in at 42.84.53. The actual low was 42.78.94. 42.78.94 versus 42.84.53 in a 4,300 point index. Absolutely incredible. So what does this all tell us? How is this important? Well, number one, we have 1, 2, 3 waves up, which suggests in our preferred view of markets that we are simply in a garden variety pullback. If this is truly a garden variety pullback in our wave 4 position, just as markets reach peak bearishness and investors capitulate into the lows, we will likely come roaring right back in wave 5. And then what's going to happen here is everybody who sold into the fear here will doubt the rally on the move back up. They will only redeploy capital on a move back through the high. They will enjoy a short bit of the wave 5. And then when the real correction sets in, they're going to doubt the real correction because they're doubting the analysts that got them out of the markets to begin with, and then the damage just further compounds. So our preferred view of markets is we are at or nearing downside support that should offer an upside reversal. Now, let's get down off of the daily charts and focus in on price action off of the January 4th high and show you where markets could go from here. From the 1 day, we'll go to a 195-minute chart. 195-minute we use versus 240-minute, as 195 minutes is exactly a 1/2 day market session. So in terms of this wave 4, there are two distinct possibilities. The first possibility is that the February 24th price low marks the end of the correction. And we're going to be providing you with here at the end of the webinar, and I know I went a little bit longer. We're going to get to the offer. I do apologize for not getting to that sooner, but we're also going to give you a take-home guide that illustrates and outlines the two distinct paths forward that we see possible right now for the S&P 500. So possibility number 1, this wave 4 actually completed. We have a move up in 1, pull back in 2, deep retracement, and markets are attempting a trend reversal. If the low is not in, and notice, remember the color coordinated fib targets that we talked about? This is the most common 4v3 Fibonacci retracement support level at 4137.75. The actual low so far in the S&P has been 4114.65, very close to that 38.2% fib retracement. Now, if the correction is over, then it's just a combination of 3 wave moves. But if we do have further to go, which based on Friday's trading action, I do think there's a good probability that we are going to continue on the downside. If we have lower to go, that simply means that our C wave, or the final wave of the correction, is likely an expanding volatility pattern. So here's your initial 5-wave move down, here's 3 waves back, and here's the final 5-wave decline. If you're new to Elliott and you're going, well, how come wave 5 is here? Shouldn't wave 5 be into a new low? This would be what's called truncation, where the wave 5 fails to meet the wave 3 extreme. While it's uncommon, it is valid. So our take-home guide is going to break down the key levels and what you should be watching for in this move. On the downside, we're looking at support between 4,000 and call it 40.5. Believe it or not, there's actually a micro gap on the chart from April of last year that was never filled at 40.20. So there's actually a little micro gap there at 40.20, which takes you right into this fib zone. Another interesting zone, or another interesting area that happens to have confluence with this fib support cluster that I'm outlining is the trend channel. Remember, we broke into the trend channel here. It gave resistance. We pulled back. We get above it, get a little bit of a pullback, and then we see this continuation move. This is essentially the first back test of this particular trend channel, and we do think it's going to deliver another 5-wave rally prior to the larger market correction setting in. Now, we wouldn't be proper Elliotticians if we didn't offer an alternate plan B to offer context in the event our plan A does not go our way. So what happens if the situation overseas escalates? Or what happens if next week the Fed hikes 1/2 point instead of a 1/4 point, and it shakes out investor sentiment once again, and we ultimately break south of this support zone? In the event we break south of this support zone, would I be anchoring wave 5 here and immediately suggesting that we have a 5-wave rally completed from the credit crisis low? Absolutely not. Absolutely not. There are many factors that go into this. I'm going to show you 2 of them right now. The first factor is the discussion that we had in regards to the move from the COVID low as being 1, 2, 3 waves up. And 3 waves does not a trend make or a trend break. That tells us that it is very unlikely cycle degree wave 5 completed here, and that we are on our way back to an 80% decline, as such as some of the headlines suggest. So what's the alternate? What's the plan B in the event we do break down further and we see an escalation, which leads to additional downside volatility? Well, remember the discussion I just had in regards to this being 1, 2, 3 waves up? In the event markets break further into this trend channel that we're now trading above, that's going to leave us with an alternate view that would suggest our green cycle degree wave 5 is actually unfolding as a diagonal motive wave instead of an impulsive motive wave. The differences between a diagonal motive wave and an impulsive motive wave is a diagonal wave requires overlap between the corrections, and within a diagonal wave, your wave 1, 3, and 5 positions can be three-wave subdivisions. So unlike a motive impulsive wave, where you need a nice 5-wave subdivision, a nice 5-wave subdivision, a nice 5-wave subdivision with clearly isolated corrections, here we would encourage the overlap, and we would allow for a 3-wave subdivision. So that tells me, as a plan B, we could entertain, and this is what our plan B is for the time being at Trading Analysis, that the 3-wave structure may have actually completed a wave 1 of a wave 5 diagonal. And the diagonal would be outlined here in this orange degree of trend. That means instead of 1, 2, 3, 4, 5, we have A, B, C to make wave 1. And this, unfortunately, allows for a deeper retracement, a more significant retracement of the post-COVID low rally, but it would still maintain north of 2191. If this view is truly at work in the markets, then it's going to take us to a variety of depths. The retracement here can take you down to 3,500, and it's fair game all the way down to 2,600 at the 786. This is where it would pay to have the understanding as to the various possible subdivisions and have an Elliottician tracking it for you in real time. So again, to reiterate our view of markets, best case scenario, we view this to be wave 4, we get another move in 5, and then the larger market correction is possible. Worst case scenario for now, this just completed wave 1 of a wave 5 diagonal, and this would allow for a more significant retracement, and it would set up a very sizable trading range, and it would be something we would be looking to take care of, or look to take advantage of, and track with our clients. Now, before we get back to the presentation and wrap up with the offers, I want to point something out here. Over to the NASDAQ, I'm going to take you to the chart that I presented last year multiple times, and that is this chart that you see here in front of you. When I entered this year, and going back to last year, June of last year, we had identified a likely stopping point for the NASDAQ 100 between 15,300 and 16,000. If you were paying attention when I was talking about the fib targets, you'll know that our wave 3 and 1, remember the 1618? The next most significant is a 2618. The 261.8% fib projection of the September 2002 through August or October 2007 rally projected from our retracement in wave 2, that's at 15.3. If we look inside of blue 3 and we look at the subdivision, guess what? Wave 3, 1618. What do we know about wave 5 when wave 3 is extended? Wave 5 is often equal to wave 1. Wave 5 being equal to wave 1 came in at 16,068.03. Zooming in from the 1 month down to the daily, you can see the markets have not reacted well to that zone. And while I would love to stand in front of you today and say, we are on our way back to 8,800 with conviction in the NASDAQ 100, markets are not reflecting a shift in underlying sentiment. We are not seeing a directional trend to the downside. Let me show you what a directional move looks like. This is a motive wave. In this instance, this motive wave was part of a larger correction. Without the context of the larger correction, you may have interpreted that to be the start of a bear market trend. Down to the daily, this is a motive wave. This is a 3-wave correction. This is a 3-wave correction. This is a 3-wave correction. Right now, this is a 3-wave correction. The guideline of alternation suggests that corrections of the same degree will alternate their corrective characteristics. So as an example, in a wave 2, if you have a directional structure, a directional 3-wave move, chances are your wave 4 is going to be either a sideways flat or a triangle, A, B, C, D, E. In this instance, in our preferred view, markets alternated. Wave 2 was sideways, and wave 4 is now tracing out in a more directional fashion. This supports positive alternation of trend. But does this look to be the start of a bear market motive trend establishing move? No. We continue to see the motive moves on the upside, moving from the bottom left to the upper right. We continue to see the counter trend corrective pullbacks, the 3-wave moves moving to the downside. Back to the NASDAQ 100, we have broken above the 2, 4, 3 trend channel just as we have done in the S&P 500. You'll notice we're about to backtest it. The last time we had this significant of a channel break was back in 1992. We met resistance at the base trend channel of the NDX origin. We break above it in 95, we backtested in 96, and then we see a huge rally into the dot-coms highs. So while we could be up against a larger wave 4 at some point in the near future, and we do think a larger market correction is on the horizon, we don't yet think it's upon us. We're going to look to take full advantage of the wave 5 that should follow. Final chart before we wrap up and get to the offers. This is the most important chart that I currently see right now for the markets. This particular chart, in my opinion, reflects the sentiment of the growth trade currently. And in addition to that, it also helps to illustrate the differences between a motive trend establishing move and a corrective counter trend move. We're looking at a daily chart of the SMH. The SMH is the semiconductor industry group within the technology sector, the XLK. And what I want you to notice about this is from January 4th, we move lower in 5 waves. We counter trend correct in 3 waves. So here's a motive wave, a corrective wave. If this were to be the shift in underlying sentiment and the start of a more significant prolonged bear market trend, then this would be wave 1 and this would be wave 2, and we would be seeing significant continuation in wave 3. Instead, we are seeing a decline in wave C that is less significant, a less significant angle of descent than the A wave. In addition, it's showing positive momentum divergence compared to the January 28th low. Looking at RSI as an example, we have 5 waves into the A wave. On the daily chart, we reach a new extreme in RSI, so a new extreme in relative strength on the downside, oversold conditions. We retrace, and as price action, and notice the overlap and hesitation here, this is not indicative of a motive third wave move. As price action is moving lower and establishing new lows in price, we're seeing higher lows in relative strength. This is positive relative strength divergence. This is a fantastic illustration of our view that markets are in a counter trend 3-wave pullback, and we see another wave 5 ahead before that larger 2022 correction is truly on the horizon. So again, we hope you enjoyed the live content. I'm going to take you back to the presentation just to wrap up and present our offers. And you might be thinking this is far too complicated. I'll never learn Elliott Wave, but you absolutely can. And if that's the route that you're interested in, we absolutely have resources for that. We have various courses. One specific course that we would like to offer at a discount today is the Elliott Wave Fast Track course. If you're interested in getting down and dirty and counting waves yourself, this is a great way to get started. Heck, if you're an experienced and seasoned Elliottician that's looking for a refresher on the rules and the guidelines or some of the tips and tricks we utilize, this is also worth checking out. This course typically retails $299. We're going to offer this on sale today for $161.80. It's about 5.5 to 6 hours of content. I host this course. Would love to have you check it out if you are interested in learning Elliott Wave. And with today's market environment, now's probably as good a time as any. You can check this out, tradinganalysis.com/fast-track. The offer will expire Monday at midnight. You might be thinking, okay, I don't have time to learn Elliott Wave. If that's the case, let us do the heavy lifting. We would encourage you to trial our services today and see how we can help you navigate the volatility and stay on the right side of the trade. We in addition to our evening strategy updates and extended market updates, we are putting out market commentary throughout the day. So if you want to stay on top of waves as they unfold within the major indexes, here's a good example of the opening gap that the S&P had on March 2nd. I put out a 15-minute chart and said the continuation structure this morning does not appear impulsive, but instead it appears corrective. This means we are still likely contained inside of wave green B in a potential flat correction. And what we were looking for is a move up in B to make A, B, and then a sell-off in C down to the 50, 61, or 78% retracement support. The B wave, the most common, notice the green color coordinating, 44.1905 was the most common B wave resistance target. The actual high was 44.1678, met resistance and sold off down to the 786 retracement. So if you're interested in joining us and you want us to do the heavy lifting, you can check it out, tradinganalysis.com/premier, $47 for a 14-day trial. I'm going to put up all the links right now. This 14-day trial for $47 gets you in the door. It lets you see what the team has to offer. You can get a taste for our analysis and approach to markets in general. This will then be billed at $177 a month monthly. You can cancel at any time, so you can cancel before the end of the trial, and we also have yearly discounts available. So those are the two offers today. 14 days for $47, or if you're interested in actually learning Elliott Wave and getting down and dirty, counting the waves yourselves, we would encourage you to check out the fast track on sale, $161.80. Tradinganalysis.com/premier for the trial, tradinganalysis.com/fast-track for the course. And then as promised, we're going to give you a takeaway today that is our 2022 trading analysis count cheat sheet. And in this particular PDF, I take you through the exact scenarios that we discussed today live in the webinar, specifically the idea that we're in a wave 4. I break down the two possibilities of the wave 4, and then we also show you the alternate plan B in the event the wave 4 zone is violated. This is our gift to you for a limited time. You can grab it, tradinganalysis.com/counts. And with volatility on the rise and the mixed headlines amongst the analyst community, you got to squelch the noise and focus almost exclusively on what the hard right edge of the chart is reflecting. Okay, so again, 14 days, $47, tradinganalysis.com/premier if you want to test drive our services, tradinganalysis.com/fast-track if you are interested in learning Elliott Wave and getting involved. And then those links again are shown here. You can also check out the count cheat sheet, tradinganalysis.com/counts. I apologize for going over, went longer than we had expected to go. Thank you all for sticking around and staying on. I noticed, gosh, the majority of you are still with us. Love it. Again, these discounts will expire Monday, March 14th at midnight, so you have limited time to act on those. We can't leave them open forever. The next level up from the fast track course would be our Elliott Wave Mastery course. I'm glad you asked. We have a refresher on that course that's coming out in the next couple of months that has taken into account the recent market volatility. Although we have our Mastery course up for sale now, we always feel it's best to update it every few years with more recent examples as they help traders and investors learn. All right, Terry, appreciate it. We've got a couple of poll questions that we would like to ask you guys if you're interested, or if you have any questions, we'd be happy to answer them.
Yeah. If you got a little bit more time and anybody's interested, if they want to throw a few symbols out there, while they're throwing some symbols out there for you to give a little basic Elliott Wave analysis, you pick the ones that look good to you. I'll start a little poll in the background here, and we'll try to gather some information for our clients so that we can make the best service we can available for everybody. Let's see here. Let's see if this works. So the first question is, what do you normally typically trade? And just select all that apply. I'll leave this up here for about 15 seconds or so. Todd usually, when he was doing this before, he would wait until he got 61.8% of the audience participated, and then he would move on to the next one. I see the request for AMD coming in, for DraftKings, for the junior gold miners, Wilson. Yeah. If you guys are a client, a current client of ours, let us know. I tell you what, with gold recently breaching back above that 2,000 again, I've gotten very interested personally in the gold miners stocks. So we are on track there. All right, let's close that. Let's try this one. All right, let's launch this one. And these are anonymous. We're not trying to spoof you or anything like that. It's just a statistical thing here. So what is the size of your speculative trading portfolio? Not your entire investments. We're not looking for your long-term holdings. It's the money that you would use every day if you wanted to enter into speculative short-term trading. Is the 2020 count sheet a separate item offered? Yeah, I sent everybody out in the chat there. I sent you the link. I think that's free. You should be able to, you just click on that, go to tradinganalysis.com/count and click on that, sign up for that, and that should be emailed to you, I believe.
All right, I see a couple of chart requests.
Yeah.
Let me
Yeah,
get
they're
my
going to get
screen share.
that cheat sheet count emailed to them right after they sign in for it. Bennett.
Yes, exactly. Yep. You will receive
Okay.
that. You will receive that via email.
All righty. A few more votes here on the size of their speculative trading portfolio. And then we will close that. Let's move on to the next one. This question is, what is your typical trading time frame? So to be fully upfront with you, Trading Analysis is not a day trading service, but we do have a lot of day trading clients that can use the analysis that we provide in their shorter term trades. We're mostly swing trading focused here at Trading Analysis, so that's anywhere from 2 to 6 weeks, but we also provide enough analysis that you can use it if you're an intermediate trader. In long-term investing, if you're a long-term investor, you can follow Bennett's work every day and keep track of what's happening in the indexes and the overall market. And you can also use those strategies to help design your portfolio.
Terry, if I change my screen share, will that mess up the poll?
Yeah, don't do anything just yet because
okay.
It won't mess the poll up, but nobody can see it while I've got
That's right.
the poll running. So let's see here. All right, let's see, I got another question here. Let's go ahead and launch that one. How would you rate your current technical analysis skills? Now, here at Trading Analysis, we have our membership includes a variety of novice traders all the way through professional market analysts. Okay, so we have a community service forum that we host in a private Discord chat. We have a lot of high quality individuals post their analysis and interact with other clients and or the Trading Analysis team there in that Discord chat. Don't be afraid to say you're a noob. I was a noob at one point, and I found Todd Gordon, and he enlightened me. All righty, let's close that one, and this is the last question, I believe. Okay. How would you rate your skills with Elliott wave and Fibonacci? So as Bennett shared with you, we've got the fast track course, kind of get you a quick jump into it, and then we have a much more advanced course too, following that. But just monitoring, just following along daily with the daily analysis work that Bennett does, um, you can see how easily we can adjust and manipulate and set up the wave counts on the charts using the Motive Wave platform. But you also really have to have a solid foundation and understanding of how those wave counts are established, the rules and the guidelines, and how they're applied. And while many of those rules and guidelines are built into Motive Wave, you still have to, you should definitely study it and educate yourself more. And the more you watch someone else do it, then you want to do it yourself. And you can use free charting software to get started. There's nothing shameful about that. TradingView is a great platform that many of our beginner clients are using. But once you get tired of manually placing those wave counts, and then when you want to adjust it, how much more effort it is, you quickly decide that Motive Waves built-in Elliott wave manipulation tools are just fantastic. All right, Bennett, I've collected the poll responses here. We thank you guys for giving us that feedback. And then Bennett, so there's the offer again. You want to run through that one more time, and then let's start taking some of these requests for some charts and do some
Yeah,
ad lib work
definitely.
here.
Just a heads up, the tradinganalysis.com/count link you posted, it's actually /counts. If you could, I don't know if you can delete that one, or I just posted it after. Thank you, Larry, for catching that. I don't know if you can, I don't know if GoToMeeting allows you to remove a message after you sent it, but either way, we sent out that link. So we've got /premier /fast-track and /counts. Okay, so let's do this. I'm going to go ahead and take you through, and thank you, Terry, for running them through those polls. I always have a tendency to get to the end of the webinar and forget. We want to obviously engage our viewers and get an idea of what it is you're looking for in the markets, how we can better serve our clients. So thank you guys for taking the time to answer those. Appreciate you facilitating that, Terry. All right, let's hit up a few of the chart requests that you guys threw our direction, and then we'll let you guys get out of here and enjoy the rest of your Saturdays. Switching it up back to the Motive Wave platform, we're going to start it off with GDXJ. Now, there's been a lot of movement recently in precious metals. We have been anticipating a post-consolidation breakout to the upside in gold for a while. We're still in the development of tracking the subdivision out of the consolidation. You can check out our Wednesday live stream show. You can check out our Wednesday live stream show every week where we do have coverage there. But specifically for GDXJ, going back to the COVID low, we see evidence of what can be viewed as a trend wave. So this can be viewed as a 5-wave move. So with this 5-wave move complete, up in 1, down in 2, smaller 1, 2, 3, 4, 3, 4, 5, we would then view this as a corrective retracement. So here's a 5-wave trend establishing move. Here's a 3-wave correction. If we look at the retracement of the post-COVID low move up into the August 2020 area high, you'll notice that the actual low of the correction, which occurred January 27th of this year, was just above the 50% retracement of the post-COVID low rally. And in addition to that, you'll notice you've got a lot of just kind of chop and slop in here. A 3-wave move up to the 618. There's that green common fib target coming into play again. From the X wave, so this is a combination. Instead of ABC, we're labeling this with WXY. That's just a combination of the Elliott wave corrective patterns. And as you gain more experience, you'll know when and where to utilize this and why it can be important. But Within corrections, very similar to the guideline Elliott offers us in regards to equality between our corrections of the same degree. So as we showed you, 4 and 2 being equal in time or price. There's also some various guidelines that are offered in regards to the subdivision or the structure of the correction itself. And in this case, we note that the equality of the initial move, so if you were to measure the magnitude of this decline, project it from that retracement, and look for an equality decline, that came in at 36.58. There's that green color coordination again between the fib targets, and the actual low for GDXJ was 36.55, 36.58. They were exactly equal to one another. Beautiful, beautiful illustration of the guideline of equality. Additionally, if we look at time elapsed in Y compared to W, notice it was equal in price and it was equal in time. Absolutely remarkable example and illustration of Elliott wave and Fibonacci at work. So from the January lows, if in fact we are seeing a true motive reversal to the upside in gold, then we see this to be the initial motive wave, the initial actionary wave, which could potentially see continuation back through the previous highs. Now, if there's a de-escalation to the situation overseas and we see the bid in precious metals fade, then there is a view that would entertain this as simply a corrective move back to the upside, which is why it is important to stay on top of the various possibilities. But what you need to see now is this directional structure needs to be met with some sort of a corrective pullback. Once that corrective pullback sets in, then you can structure in your risk by number one, placing stops at the lows, because we all know that a break south of the origin of the move would invalidate the trade and the trend, more importantly, as you can see with motive wave squawking at me, letting me know wave 2 terminates beyond the origin. So looking at this, let's say we get a pullback to 42.87. Well, in that instance, you'd be assuming about 16% of downside risk to get 35% back to the first target and 63% potentially back to the wave 3 target. So look for the correction. You need to see evidence of a correction to confirm the continuation for GDXJ. Next, I'm going to take you to the chart of Honda Motor Company, and we're going to go over to Trading View for this one. So remember I mentioned earlier about corrections that occurred, way back in time. I could show you corrections that occurred during the Great Depression that have dictated depths of corrections in indexes, in the 60s and the 70s. So this is the chart of Honda Motor Company. The chart of Honda Motor Company going back to 1978 has a 5-wave rally in one, our first wave 1, a wave 2 pullback, 5 smaller waves here in wave 3, and now we're consolidating in wave 4. Higher lows, lower highs, nice consolidation, which is typical of what we call an Elliott wave triangle. Now, let me show you something over in motive wave on this same chart. Let me switch you back to motive wave. Back in motive wave, we're going to look at the weekly chart. This is that sideways triangulation that we were just looking at, okay? The wave 4 being equal to the correction that occurred in the late 70s, coming off of a $40.82 high, the equality of 4 compared to 2, meaning that this correction would be equal to the correction Honda Motor Company saw in the late 70s, came in at $18.26. We knew that coming off of a $40 high. The actual low, though, thus far of this sideways correction was $17.35. There's a beautiful example of a correction that happened many years ago, 40, 50 years ago, that is still of significance in dictating the depth of corrections today. Over to AMD. I'm glad you asked about AMD. In AMD, we have 2 distinct views and possible wave counts. The first wave count would suggest, we're looking at a 3-hour chart, that's fine, Over here, we identified in September of 2020 a wave 3 high. The wave 3 high delivered a sideways consolidation. And remember that chart of AMD, that 1-2-1-2 move? We were looking to trade wave 3. We counted this as 1-2-1-2, put a trade on here. That was that example we showed you. So we traded coming out of the triangle. And I want you to notice what happened in May of 21 all the way up into November 30th of 21. Shares of AMD rally in what is best counted as a 3-wave move. You have 1, 2, 3, 4, 5 up, A, B, C down, and another 5-wave trend in this orange wave C. What did I just show you in regards to the corrective legs often exhibiting equality to one another? We were looking at GDXJ, Y versus W equality. Look at this. In AMD, from $99 a share in the B wave back on September 20th of 21, all the way up into November 30th of 21, the magnitude of its post-triangle rally, which is May 18th through August 3rd, if you were to measure the magnitude of that, project it from your B wave, look for an equality measurement, that was 167.52. The actual high that we've seen so far, 164.46. Absolutely incredible. So this is a 3-wave move. This is exactly like the discussion we had in the S&P in regards to my view that if we do violate my wave 4 support zone, that we're actually in an ending diagonal, which would allow for the 3-wave subdivisions. And I'm tracking that same possibility here in AMD. If that's the case, AMD did an ABC correction, 5 up, 3 back, nearly violated in that the 786 retracement was broken just briefly, but we didn't move past the origin of the wave 1. But due to the market volatility, we're aware of our alternate view of AMD. And our alternate view of AMD comes into play if price action breaks south of wave count invalidation in 99.36. That alternate view would suggest that AMD actually met its wave 3 top into its November area highs. And what we actually have at work, and notice the 1618 at 137, what we actually have at work is a larger ABC pullback. And this ABC pullback could take you down 67 up to 77 before reversal. As Elliotticians, we know that in the event we get 5 down and 3 up, we can trade the continuation move down and C. This is just like the chart I showed you of Tesla, where once we had that first 5-wave move, we tracked 3 waves back into 760 to 780, looking for the move to 500. So this is one you need to stay on top of. Okay. Alrighty, I think I'm going to go ahead and leave it at that. Any other questions, comments, concerns? Please let us know. We would appreciate you guys reaching out if you ever have any questions. The most important chart of the growth story, in my opinion, is the chart of the SMH, Semiconductor ETF. Beautiful, beautiful A, B, C, 3-wave counter trend pullback in development prior to what we feel to be a move likely to new highs. Terry?
Let's take a look real quick at the results of that poll, Bennett.
Yeah, let's see here.
I don't know if you can see it or not, Bennett. So what do you normally trade? Stocks, shares of stocks, straight out, right? 73% of our responders answered that. 43% like to trade stock options. That's perfect. That's right in line with what we do here at
I was going to say, Terry, on that topic, I would say that probably somewhere between 40 to 50% of our client base utilizes our market analysis for their own personal stock and options trading, independent of any of our team signals.
35% of our responders here are trading cryptos. They'll be highly interested in Alex's analysis. 11% trade Forex and 14% trade bonds. We occasionally talk about bonds. We used to have a Forex service, but we didn't have enough followership of that, and it was with crypto coming on and our limited capabilities, we decided we are going to spend more time focusing on cryptos and building
And
that
not a lot of
diversity.
forex volatility when we took it off as well.
Yeah, here is the size of their speculative trading portfolio. You can see we've got several viewers with greater than 100,000 that they manage themselves. And we have several with small accounts. That's nothing wrong with that. You got to start somewhere. Let's take a look here. Your typical trading time frame. Mostly a swing trader, intermediate trading. There you go. That looks like a great bell curve there. Perfect fit. Okay, and let's get to this. We've got basic understanding of charting and indicators. You got a good quality audience here today, Bennett. And looky here, I consider myself proficient with multiple technical analysis techniques, 34%. So we got a highly educated group of technical traders here today. Let's see. And let's see, finally, how would you rate your skills with Elliott? Well, nobody said Elliott who, so that's a good thing. But you've got an audience here, 24% says they don't know how to use it. 55%, so the bulk of the subscribers use it all the time, and that's why they're here listening to us. And then we've got 21% saying they have advanced Elliott Wave skills and they are ready to help all the newbies learn how to do this. All right. Well, thank you guys for letting me share that with you. Thank you for sharing your information here with us. And all right, Bennett, final
Very good,
thoughts?
Terry. Yep. Final thoughts. I'm going to take them through one last chart request. And just so you all know, you can tune in to our Wednesday live stream shows. We are going to be introducing once a month a segment within that where we do some member or viewer requests. But what we're looking at here is the chart of Tesla. And in addition, we also facilitate chart requests for our clients in our evening updates. But going back here in Tesla, and I'm not going to show you the weekly, I'm not going to show you the daily charts because Tesla has a couple of valid higher degree wave counts. And when I say higher degree, I mean a wave count that encompasses the entirety of its price history. In this instance, we don't really have to be aware of that higher degree pattern because they are both in support of a continuation move, provided markets maintain this downside support base. But what we're entertaining as a possibility for Tesla is going back to its November 4th high of last year. Tesla has a 5-wave decline, a 3-wave retracement, and then another 5-wave decline. This 3-wave move was met with another 3-wave move to the upside. There was an acceleration gap that occurred on January 2nd as markets bid their bullish delivery numbers. That resistance was met into January 4th. The broader market indexes met resistance and started a distribution move. So what do we know about Tesla up until the January 4th high? We know we have a 3-wave decline and a 3-wave retracement. This is exactly what the S&P 500 did from September of 18 into December of 18 into February of 20 before the 5-wave COVID decline came to make the C wave. So this is the exact same pattern, but on a much smaller time frame. 3 down was met with 3 up, and now we have 1, 2, 3, triangle 4, down in 5. Often we see our C wave meet support at a 1272 external retracement of the B wave rally. And I want you to take note of the fact that the bounce on the 28th was more or less in line with the 1272. Yes, we did get an acceleration south of that area of support, but we ultimately have moved back above it. This is a good example of when there are situations in the market, there are headlines in the market that ignite additional uncertainties, that those extremes can be violated if just briefly. Here in Tesla, it's a good example. So this is potentially a completed flat correction. And if this is a completed flat correction, we just established our first mode of trend reversal, and we're working some sort of a three-wave pullback. If this is the case, Tesla needs to maintain a bid north of the 786, so between 736 and 767. Currently, we're seeing support at the 50%, and this is one name we're tracking with clients as it would offer an incredibly favorable reward risk opportunity into support. Let's imagine, as an example, we move all the way down to the 786, and we know that in the event Tesla moves 5% south, the wave pattern is invalidated and we are moving lower. So that's 5% of downside risk you would assume to take in 29.5% back to the first target and then 50% back to the more extreme target. This is why Elliott Wave is utilized by individuals such as Paul Tudor Jones. So that's it. We're going to leave it there. We've kept you guys long enough. Just to mention those links one more time, and then we'll let you get out of here and enjoy your Saturday afternoons. Tradinganalysis.com/premier if you would like to test drive our services. 14-day trial offer that will renew at $177 monthly if you do not cancel within the 14-day period. The fast track course, if you're interested in learning Elliott Wave, typically $299 on sale for $161.80. Tradinganalysis.com/fast-track. And our 2022 count cheat sheet can be found at tradinganalysis.com/counts. It's going to ask you to input your name and email address, and you will receive an email with that PDF available for download. Appreciate it. Thank you all for being here. Again, check us out anytime, tradinganalysis.com. Navigate the volatility. And Terry, excellent work. Hope you enjoy the rest of your Saturday.
Yes, sir. You too.
All right.
See you guys later. Hope to see you guys as subscribers real soon. Bye for now.
Have a good one. Take care.